Portfolio Builder members, welcome to our Friday Trade Alert. And we finally hit a win on the SPY. I'm expecting a significant rally in the SPY ETF over the next several weeks, anticipating a period of peace in the trade war. Now, there are some problems with that thesis we'll take a look at with breaking news just in the last few minutes. So we have to pay careful attention to that. But I think the Chinese will be willing to be somewhat easier on dealing with trade due to their anniversary coming up on October 1st. However, we're not seeing the U.S. reciprocating yet, so we'll see exactly how this all plays out. And meanwhile, the Hong Kong situation is continuing to escalate, which is China's access to outside capital. They cannot lose control of Hong Kong. To review our trade from last Wednesday through today, the SPY traded from 296.38 to 297.36 for a 98-cent gain. Our protection was the option collar. We paid 21 cents to get into that option collar and a penny to get out for a loss of 22 cents. And again, that's the whole point of the collar. It acts as a drag on our returns, but it protects us from serious downside moves. We're selling call options to finance the downside protection at this current point in time because we believe the SPY will travel significantly higher. And the big news really is that the media is leaking, the Fed's leaking, the speakers are leaking, the central banks around the world are leaking that QE4 is around the corner, potentially starting in November. And the whole repo madness is just the prelude. So this is extremely bullish for the stock market as long as we don't get a massive worldwide panic due to trade uncertainty. So that is a 76-cent profit per share on 1,700 shares, or a $1,282 profit in the past 48 hours on the SPY. Now again, we don't recommend you only trade the SPY. It's smart to have a stock-bond ratio and then some exposure to precious metals. Now, if you think about if all the central banks around the world are lowering rates, printing money, they're going to devalue all their currencies. The United States is about to jump in the same boat. This is going to make the relative value of gold and silver go dramatically higher. And until they reverse course, which probably won't happen until we see some pretty serious inflation, it's a pretty set path that the central banks must take. And the next big move is they're going to help these big primary dealers who are loaded to the brim with treasuries exit these positions for huge profits and free up their balance sheets, which is causing the dollar liquidity problems right now, which we're seeing drive the value of the dollar sky high. And let's just take a look at that chart. You can see the dollar index just hit a new high for the year at 99.16. So this is remarkable, and in the face of the Fed are already dropping rates twice. So that just shows you how weak the currencies are around the world and how much money they are flooding their economies with to try to avoid a recession. So normally rate cuts and QE happen during a recession and during a stock crash, but now we're going to do it while the SPY is a few dollars away from all-time highs. So give us a farm deal, delay the December 15th tariffs, and the SPY could go way beyond my target of 315, which I think it will float to in October. And again, that's if the U.S. is starting to show some signs of reciprocation with China. So we'll jump into that in a little bit, but this is a review of the current trade. Let's see if we have people live. If you're live and want to say hi, please do so. I know the prices have been moving around a little bit, but the exact strikes are exactly what I would still recommend in terms of where to place your put and your call. As the $300 strike is a significant resistance level right now that I don't think will break through before Monday. And meanwhile, There's just so many risks in the market. You don't want to own equities without downside protection. So if we zoom in on our track record here, what I want to point out is not the return of 16% this year, which is significant. What's more important is to compare the maximum loss in a single month relative to the profit. And so if you go look at your own portfolio, and perhaps in May or December, if you had drawdown that was greater than 1%, perhaps in the 2, 3, 4, 5% range, to have the same risk to reward ratio that our strategy has, you'd have to multiply that significantly. So if you have a maximum drawdown in your past trading history of 2% or 3%, well, then you would need a 30 or 45% gain to date to have the same results we have in terms of risk against reward. Welcome, Tom, and welcome, Anthony. Thanks for saying hello. So that's a quick review of how we have our assets allocated. Monday, Wednesday, Friday, we're trading the SPY. Tuesday is currently in silver. I see this as a 2 to 3 year play because that's most likely how much room the central banks will have to do QE before we get massive inflation and they have to reverse this course. Meanwhile, we have a buy and hold position in GDX where we're not doing the calls and puts. And then on Thursday, we're trading the TLT. The TLT has racked up considerable profits this year with extremely little drawdown and has been relatively easy to predict because we can look at Germany primarily to get a good hint at where our rates are headed in the future. Hey, Ernest, how's it going? So that's a review of the portfolio. We'll jump into my news in a minute. Quick little PowerPoint about who we are, and then we'll jump into the most pertinent news that has been coming out and charts. There's a look at our disclaimer. Our program is extremely easy, on-the-go daily retirement income trade alerts. We have call options to create income and put options to protect against downside risks. Why make investing complex? Don't you have better things to do with your most precious asset, your time? Our strategy only requires 4 ETFs, period. How many stocks do you have in your portfolio? My promise to you is I will help you protect your assets and show you how to pick the low-hanging fruit. Our put options hanging right below the SPY and TLT ETF make it impossible to lose very much money, period. Our goal is income and safety, not growth or speculation. The target return on investment is only 1 to 2% a month. And we've only had one losing month of negative 1% with an average of 2%. Watch this daily YouTube video and you'll know exactly the rhyme and reason of every single trade alert. Here are a few different setups you can use to build your portfolio and follow our strategy. Now remember, if you use Interactive Brokers, a simple deposit of $25,000 will give you $100,000 buying power. And also keep in mind the SPY ETF represents 504 companies. I guarantee you 100 shares of the SPY ETF is a far better investment and long-term strategy than any other collection of stocks you currently have in your portfolio. It makes a lot of sense to consolidate those, buy the SPY. Now you don't have to watch a million charts every day, and you have extreme diversification. And you also don't have to worry about whether Wall Street is rotating from financial sector to utilities to growth to value and all that jazz. The SPY ETF does that for you automatically and for free. So it's a much better product. Plus, it has options expiring Monday, Wednesday, and Friday. If you're invested heavily in a single security, you are at risk of business risk. One little bad news flow could send your individual stock flying down, whereas it's extremely hard to create a major sell-off in the entire SPY index. Silver we'll take a look at a little later. This has a huge catch-up to do with gold And in the face of QE4 starting up in likely November, I'm expecting some serious room ahead for silver and gold currently. TLT is the long end of the treasuries, and this gives us ability to profit much more handsomely than actually owning bonds. We're just playing the rates. And again, the only position we are not protecting with puts and calls is our buy and hold position in GDX. Now this is important. GLD is spot gold. No reason to own that now. We already played that all year. And now it looks like the central banks will put a ceiling on gold around 1,500. So it's the gold miners who can turn a huge profit now at these prices that we want to be heavily invested in. And GDX is a beautiful ETF that gives you automatic index investing into the top most profitable gold mining gigs. And after reviewing certain portfolios of different clients of ours, I've noticed that many people playing the gold mining space end up with these tiny gold miners who actually have no capital to actually mine any gold. There's really just two major players in the gold mining space that can write checks from JP Morgan and all the big billionaire hedge funds on demand to quickly get their rigs rolling and actually mine gold right now while the prices are elevated. So GDX is definitely the best way to play the gold market versus trying to handpick certain gold stocks. Now, if you want to get rid of the Tuesday trade, have a little less work, here's another allocation that has a $66,000 build out price. But again, remember, if you put 25 grand into Interactive Brokers, they're going to give you $100,000 of buying power. This would have you trading 100 shares of SPY Monday, Wednesday, Friday, and 200 shares on the TLT. So you have that same equity to bond ratio plus the same 10% position in gold. Want to play it super risky? We're going to be playing the long-term trend that the central banks are easing monetary policy and starting up QE. This is extremely bullish for silver, which has a massive catch-up to do with the spot price of gold. So this has a 15K investment in SLV, which is the silver spot price. Now the price of silver, again, has not caught up to the spot price of gold in terms of relative gains. And as soon as it does, we would switch over to SIV, the miners in silver. Same concept, little less capital to get going, much bigger potential return than the other strategies, but you're going to have to sit on some pretty hefty volatility playing these markets. Now, if your trade alert email is missing the trade alert today, that means your free trial has expired. Call Dean at 505-322-7515 so you don't miss out on trade alerts coming out Monday. He's an expert trader. He follows our program plus does his own trading, so he can answer all your questions and get you on the right track. We have a live webinar that you can speak to our other members and get to know other people who have been following the program for months. Wednesday at 1 p.m. is our paid-only webinar, and Thursday is for everyone. So make sure to book your calendar for that. You'll get an email from us with a Zoom link. Don't forget to subscribe to our channel and click on the little bell. Now, a lot of people have been wondering exactly what we offer and what the prices are. I do want to put a note out that if you go to the description box, I have a bunch of links in here. One is a link to learn about our advisory, the other is about our boot camp, another is pricing options, and then plus we publicly post with no password protection every single trade alert right here at this link. So if you do want to audit our returns and make sure we're the real deal, go for it. And I bet you can't find another advisory out there that publishes every single trade alert verbatim with this daily video and a link to the track record for free to the public. Here's a quick look at the advisory page, overviewing what you'll get. Here's a look at our 16-week retirement income boot camp. This does have a bonus trade where we're going to take advantage of the Chinese currency collapsing. This is going to be extremely profitable, and there's no way to do it in the stock market. You have to use the futures market for this to work. So If you're interested in getting a very, very detailed education in our strategy and how to follow the program, definitely check out the boot camp. Here's a summary of that. And again, all these links are in your footer. And then if you want to review the different options, go to portfoliobuilder.io/options. We have a package where you can get the boot camp and advisory in one single offer. So check that out. All right, let's take a look at what's going on in the world. So the dollar index continues to climb, and this signals that the rest of the world is having some serious problems. This forces money to make its way to the United States in the form of treasuries, the dollar, and the U.S. stock market. That's why all other stock markets around the world are significantly sold off from their highs, and America is getting ready to rip through all-time highs. Now, I've been talking about shorting China's currency, as I believe they are going to do everything in their power to try to protect their bond market and their stock market. To do that, they cannot let the valuations of these products completely collapse. So when put in a tough decision, I believe they will print money and devalue their currency to try to protect their markets and also to protect their exports. Without exports and without all these ridiculous projects to build things all around their area, which we'll talk about too, their economy is going to collapse. So it's quite predictable what they do anytime something bad comes their way. And we saw that just in the last few minutes. This is the trade I've been talking about, folks, that we're going to be doing in our boot camp, and the time may be coming as soon as next week. So let's look at what's happening and show you an example of how you could have made 20% return just in the last 30 minutes from this concept. So we've seen Chinese buying U.S. agricultural products this week, soybeans and pork. And here is something from their Twitter feed. There are many reports in the U.S. recently on China buying U.S. farm products. The purchase obviously signaled China's goodwill, not concessions. China and the U.S. need to create real progress in trade talks so that such purchase can be sustained. Okay, so in other words, they're running out of pork. What was the U.S. response? Now, I've been also talking about how the U.S. could quite literally outlaw the investment into all these Chinese investment products. And we have the person who used to run their stock market here in the U.S. going around to the Congress, and this was from Kyle Bass, trying to convince everyone that we do not need to have any audit of Chinese companies where American retirement funds are flowing to the tune of billions of dollars. So the banks and big hedge funds are all in bed with China now. And I believe that's the only thing keeping this deal together whatsoever. The big banks have billions of dollars trapped in China and they have no way to get it out. And what was the Americans' response so far? Absolutely nothing positive. We heard Trump say all week, even in the face of impeachment, that he will not accept a bad deal from China, that farming agricultural product purchases are not enough. And then just minutes ago, stocks slammed as U.S. weighs limits on portfolio flows to China. And look what happened within seconds. The currency immediately started to devalue. There is no way to play this except for in the futures or Forex market. Now, the Forex market is the wild, wild west and not something I would recommend using. The futures market is guaranteed from the CME and a much smarter way to trade the devaluation of the Chinese currency. So we'll see. If these trade talks do not make some serious progress and we don't see Trump saying something positive about the trade deal as we enter into this period where trade talks are supposed to reconvene on October 11th, we're going to want to jump into that trade. And the idea is simple. you sell the currency today's price and buy it in a future price at a discount. The difference is your profit. This again is something we'll be teaching people how to do, including timing, in our boot camp program. So if you're not in that yet, consider jumping in. Scotty's in it. And so Scott, we may be getting you some content out before the official November start date. So also you may want to go to your broker and make sure you're approved for futures trading. This trade takes less than our options trades takes to put on, but timing is incredibly important. Okay, some news on the impeachment front. We've got Trump going off on Adam Schiff, who took the notes of the call and made up his own words yesterday on TV, which is creating quite a bit of outrage today. And it's hard to tell what exactly is going on with this, but if you do study into it, it looks like there's a lot of illegal dirt coming up about Democrats getting money to Ukraine and then getting benefits back out of it from the Obama era. So there's a lot of dirty hands in this, and perhaps that's why they're trying to make such a big deal out of it and make people look the other way. Here's some interesting data on China. China, of course, says their books are state secrets, so we can't look at any numbers of accounting that's internal. So what can we look at? External data. And this report shows that just about everything is on the decline, except for one item. And if we zoom in on it, this is bad news for China. The one thing that is on the rise is inflation. Too much inflation will make it very hard for them to continue expanding their debt level. But you can see everything is rapidly deteriorating in terms of growth. Here's a look at the collapse. Here's their official GDP, supposedly, and you can see just how fast this is crashing. This is not healthy. And people say, well, it's still 6% GDP. According to this analysis, it's much less. But the rate of change is what's important here. This is devastating to their economy. And with the U.S. applying pressure to them, it's going to make this get much more rapid. Meanwhile, the construction companies in China are having tremendous problems. I watched a YouTube video last night where this guy, these are not financial people. These are just people who were attracted to China because of its massive growth over the past several decades, who like to go ride around on their bikes or motorcycles and travel China. They were huge fans. Many of them found their wives, created children's out there, and you can see the deterioration is happening rapidly. And what I saw yesterday was this guy riding his bike through a luxury ghost town. These were millionaire mansions, thousands of them, deteriorating, completely empty. The only person there was a security guard and maybe one person living there. So they have massively wasted money building construction to try to keep their populace busy. And now once the world cuts them off of credit, this is going to be the Lehman moment that takes down the entire global economy. So without a China trade deal, I fear China will collapse its economy and create a stir through the world. Here's some of these construction companies with dollar-denominated debt coming through. There's the global manufacturing PMI dipping below 50. This is causing all the central banks right now. Just saw a report out of Interactive Brokers this morning, macro analysis. 80% of all central banks are already in the phase of lowering interest rates or starting up QE. So that in itself is very bullish for stocks. Most likely these central banks are going to come in and gobble up all the bad bonds, let the banks once again get bailed out, take profits on these assets they could never sell, and free up their balance sheets. So if we do get a U.S. trade deal, even if it's just a small farm deal where we push the December 15th tariffs into next year, I think we could have a massive rally. On the other hand, if we do not get that and they escalate in October during the holiday anniversary, things could get ugly fast. That's why it's so important to have that stock bond ratio and the precious metals asset. Now, we're not expecting, guys, each asset to go up together every day. That's not the way our strategy works. One goes up, the other plays protection. Meanwhile, WeWork, they fired their CEO. They're selling the guy's private jet. Apparently, they're canceling leases that were to the tune of $45 billion, even though they only have $5 billion of commitments. Everyone's trying to figure out what's causing this repo madness. Is it HSBC Bank? Is it Deutsche Bank? Is it Chinese banks? Maybe it's SoftBank, who has put way too much money into these unprofitable tech companies like WeWork. And so WeWork's IPO is in some serious concern. Their CEO is fired. Lots of drama here. SoftBank could potentially be one of these banks in serious trouble. Their bonds are crashing in value. Meanwhile, Facebook decided to delay Libra. Apparently, they believe there's too much drama circulating around the world right now and are looking for a better entry point and more feedback from the central banks. Perhaps central banks aren't too happy that they're coming out with a solution to fix losing the value of your currency. At the same time, they're about to devalue currencies worldwide. Trump's approval rating staying strong despite the impeachment noise. Clear cut Elizabeth Warren versus Trump going into the election. It looks like all Trump was trying to do was get Biden out of the way. Here are some probabilities of what could happen with the impeachment information. I think that it would be bearish, very bearish for the stock market if he were to be impeached. We need 2/3 of Congress to vote against him, and I believe since he's given so much money to the military, that is unlikely to happen. So perhaps the Democrats are just trying to create more drama and slow down anything from happening during his term. Now, a lot of people are saying, oh no, the U.S. is creating too much treasuries. But today and earlier this week, foreign demand for treasuries, despite the risk of the exchange rate of their currencies, has been red hot. So that red is the indirect bidders, and you can see they are buying up treasuries at record rate right now. This again will feed into the GDP of the U.S. and help these corporations continue to print very nice profits and keep our credit market strong. Buybacks. That's the big secret to our stock market rally, and it is at record pace. Here's a breakdown of who's doing the most buybacks. The process of buying back their own stocks makes their EPS go up, and this continues to drive stocks higher and higher. And we can see just how much buyback activity there is. A lot of people talk about these blackout windows, but we can see clearly, although there's spikes and troughs, there's no absolute blackout period ever. Buybacks are non-stop. And insiders are selling at record pace. Now, I will point out the last time there was a massive insider selling was during a crash, not before it. Go back to 2000. So I'm not sure that's really a great indicator that we are anywhere near a crash at this point. What it does do is allow cash to escape from the stock market and flow into the economy. So let the insiders sell to their corporate buybacks while they can. And there's your source of the rally since 2009. Red is the buybacks. Until the circle of corporations being able to get free credit, especially in foreign debt, then go turn around and buy their own stocks back, it's going to be very hard to get a significant sell-off in U.S. equities. Corporate debt to GDP ratio getting back towards new highs. But again, the credit market is at all-time lows right now. Negative rates. This has never occurred before in history. Pulled this up. Interesting to see that Germany, who is in a recession, has a low debt to GDP because they're trying to work down the levels of debt and the slowing economy due to China's slowdown. And now we're seeing France getting ready to crash next. The repo madness is having a little less trouble today, with only $49 billion out of 60 being used on the 14-day repo operation. The long view consensus is that the trade is adding lots of friction to the global economy, and recent weakness is tied to the escalation of trade policy. This also matches up with the observation that global manufacturing is slowing much faster than services. I'd like to offer two other theories. China has driven and continues to drive the global business cycle. Most weakness is emanating from here, with a sprinkle from emerging market shocks like Turkey, Brazil, Argentina. Unfortunately, data is opaque in China. One hell of a blind spot. The first theory is that China isn't slowing because of the trade war. Things were already slowing before Trump's tweets. And look at 2015 and 16. They almost crashed back then with no pressure from the U.S. And since then, they've made the circumstances much worse for themselves, and they now have the world's strongest economy applying massive pressure. Deleveraging efforts to control shadow banking and higher rates from the Fed were primary forces. Both have paused for now. The second is more micro. Weakness is concentrated in two sectors, mostly in auto. So we are seeing auto slow down worldwide right now, due to changes in emissions in Europe last year and China this year. That's a hiccup. It will pass. The second are a weakness in electronics. Think of Micron having lower earning expectations yesterday. This may sound extreme, but I think weakness in this sector could be driven by, wait for it, Bitcoin. The investment in GPU and other hardware was massive in 2017 and likely represented a sizable chunk of hardware investment. In a world where year-over-year changes matter, it's a big variable. Maybe. I am no expert in China, autos, or hardware, but I think these, along with changes to tax policy, can explain much of the recent variation in growth as the trade war can. Would welcome others who are more specialized to comment. If it's the first, I would hold my nuts and keep a close eye on Chinese credit and money supply. Or their currency exchange rate is my favorite to watch. We've seen every single time they devalue their currency, equity markets have a fit. Plus the leaders have a fit, especially Trump. If the second theory is true, it means that the data will likely turn in the next 6 to 12 months and will be boosted by the inventory cycle, which the trade war definitely impacted, and lower rates. So it boils down to, do we make a trade deal or not? If we do, and we have all the banks printing money and lowering rates, we could have a huge boom in equities. And here's some more data showing the crash in exports in Asia in general, similar to the crash we saw in 2015 and 16, where the markets nearly crashed and they went on another credit binge. And meanwhile, Bloomberg clearly supports China. The biggest U.S. banks want a slice of China's $9 billion annual financial sector profits. Executives from J.P. Morgan, Goldman Sachs, Morgan Stanley, Citigroup met with PBOC Governor Yi Gang and top regulators in Beijing in a sign that the trade war has done little to derail China's opening of its financial system. Hong Kong, while the protests that have roiled Hong Kong for 4 months appear no closer to resolution, their economic impact is becoming increasingly clear. This is China's outlet for getting money from around the world, and also why they're trying to buy out the London Stock Exchange. So this little piece of news and these riots could be much bigger than everyone expects. And this is right ahead of their holiday anniversary starting next week. What's going to happen this weekend? Next, China. Birthdays are important, especially during a trade war. President Donald Trump seemed to get that point when he decided earlier this month to delay the imposition of new U.S. tariffs so that they wouldn't start on the same day China celebrates the 70th anniversary of the founding of the People's Republic. That day is Tuesday. It was 7 decades ago, on October 1st, 1949, that Mao Zedong declared the founding of a new Chinese state under Communist Party rule. Since then, China has undergone extraordinary change. It's transformed from a poor and largely agrarian country into the world's second largest economy. If anybody saw it yesterday, they released this huge new airport. It's insane. It's giant. It's some $50 billion airport. Another case of them building things that are not necessary while the rest of their population lives on peanuts. Tax rate of over 70%. Hundreds of millions have been lifted out of poverty, and China is now at the forefront of an increasing array of technologies. A chance to celebrate those accomplishments is not something to be wasted, especially with all the challenges now facing President Xi Jinping's administration. The trade war and Hong Kong's ongoing unrest grabbed the most headlines, but just as tricky are some of China's slow-burning dilemmas around debt. Trade war. China purchases U.S. farm goods have been the most important factors determining the mood music of the trade war. It began with buying soybeans and then pork. And now we're not seeing any reciprocation from the United States at all, which makes me very nervous going into the next several weeks. And remember, the next tiny increase in tariffs, only a 5% rise, is on October 15th. So that's less than 2 weeks away. Here is the soybean purchase chart, so nowhere near what we were at, and you can see how they completely cut off purchases, which is causing massive price increases in food in China. And when you're only making $10,000 a year to start and you get taxed at a 70% rate, what does that work out to? Something like $275 a month to live on? Now you get free housing, so that's nice. You get free medical. So really all you got to worry about is your food. So what do you have? $10 a day to live on. Not easy when food prices have gone up 50%. Here is what I've been talking about. The way to short China may not be through their equity market. China's plunge protection team owns 6% of its stock market. It's been dormant in the past few years, but it is clear they are happy to do what Japan does. Now, Japan owns 60% of its stocks. What a joke. China will most likely devalue their currency, print money, let the people have inflation, and try to support their capital markets so they don't get cut off of money from the world. Without new loans, they're not going to be able to keep this gig up. U.S. commercial bank assets, U.S. Treasury and agency securities. So our banks have swapped out dollars for $3 trillion worth of bonds. There's no way they could sell all that without making rates spike. And so to me, it's quite clear what has to happen. The Fed has to pick up these bonds off their balance sheets. This will relieve the repo madness where there's a dollar shortage, and it's going to let them all get out with a huge profit in this position. So this is expected to begin at a rate of about $40 to $50 billion a month starting in November, and potentially a infusion one time, maybe next month, of several $100 billion to start this all off. So that's what to look out for. What are the banks going to do? Well, if we have trade war escalation, they're probably going to just buy more bonds and wait until the drama is over. if there is some sort of relief in the trade war, I expect they will sell these to the Fed for a nice profit and load up on the SPY. And you can see the balances of the reserve banks is getting low on cash. This is what's causing this repo madness. Not necessarily the US banks are in trouble. It looks like foreign banks are trying to withdraw cash at record pace, and the banks don't want to lend it. Now, it's not clear who exactly these banks are. They call it the black box. They use hundreds of intermediary banks to hide the true problem that is causing all this drain on the dollars. It's probably a lot of banks in China and in Europe who are in trouble right now. And we can see the Fed's balance sheet is ticking back up. Of course, we can go back to 2008, right before Obama came in, and we had something like $500 billion balance sheet or less. Quickly after he came into office, we ran it up to $2.5 trillion, and Bernanke told us this would all be undone. It was a short-term fix. Well, they sold $500 billion of treasuries in 2018 and almost crashed the world markets. 98% of all assets crashed during that tightening period. And most likely we're going to jump way above that $2.5 trillion in the next several years. So that is why we want to hold on to our gold and silver, even if it's volatile and has big moves up and down. This is the path we are on. And of course, Bloomberg trying to talk trash about the U.S. Treasuries, causing the repo madness and such. Saying, oh, the Chinese aren't buying our treasuries, but we just showed you the demand for treasuries is red hot from foreign investment right now. So we're having no problem selling our treasuries, as it's the only positive yielding bond in the world that's worth a damn. Okay, and here's the Bloomberg article, which I disagree with. Repo meltdown shows budget deficits has limits. So they're trying to blame the administration's big deficits for creating the repo madness. Maybe eventually that will be the problem, but certainly not yet. And these dealers could be flipping their bond positions right now for a profit, but instead they're hanging on to them. Most likely because they want to sell them all and not just a few. And they need the Fed to come in and take these positions out. Betting markets are saying Biden is the real loser here, shaping up to be Warren versus Trump, which is what he wanted all along. Warren's going to have a hard time getting the money from all the big corporations and the rich. So that's interesting if she really does become the Democrats' nominee. Campaign will be brutal. Trump knows his likability is low due to constant negative coverage. His goal will be to do the same to Warren. North Korea is getting impatient, says lack of progress casts doubt on prospects for future summit with U.S. Last thing we need is them firing off some bombs at Japan. Everything Trump's done over the last 6 months has been for one goal: get the other party to self-destruct. It's happening. Here's that Chinese conversion rate against the dollar. We can see a pretty significant trend here. They either protect their currency or they protect their stock market. Can't do both. Not when they have a collapsing GDP and immense pressure from the world cutting down on their exports and manufacturing jobs. Meanwhile, the euro continues to weaken against the dollar. And the German yield continues to 30-year bond below zero. Those are bonds that are guaranteed to lose money. Who's buying them? And why? They're buying it as an insurance play to try to create a profit from further downturn. So the central banks really have no choice. They're going to have to bail out these banks, get them out of these bonds. Some more upset tweets from Trump. And again, the live stream doc's in the description box if you want to spend more time on it. Finally, I have some charts. So here's our SPY. You can see it is ready to leap beyond 300 with good news from the trade war, or even just a pause in bad news, I think is enough. We've got farming purchases, we've got hope, we've got the anniversary, we've got the Christmas season coming up. Will we get a delay in tariffs from Trump? I think that's what we really need, is December 15th tariffs being delayed into January. That would be what would take the SPY much, much higher to close the year out. TLT, I unfortunately believe is going to go much higher, just not right now. I don't think it's going to crash much because the Fed's going to come in and buy up these bonds and support the bond market. But the next time the trade war does not have a good turn and we get Trump raising tariffs, look for the TLT to rocket to new highs. So 148 was the last level. How high can it go? How low will they let the rates go? We know they can go to zero just based on the 08, and I think that's as low as they will let it go this time. GDX, just to get back to the to levels from the last crash, would push this up towards 66, but the problems are much more magnified now. It's not just Lehman Brothers and U.S. residential. It is 100 times worse. It's the entire economy of China's on the brink of collapse, plus all of Europe. It's going to be a huge amount of money printed to try to support all these bonds. Think about it. There's 18 trillion in negative bonds out there that need to be soaked up by the central banks. That money is going to flow elsewhere once it is released. Silver, again, the play for gold and silver is first you play the spot price till it has a huge run up, then you play the miners. So we got the run up in spot on gold, so we switched from GLD to GDX. Now we're playing the same concept on our Tuesday play. We're having some drawdown in SLV on our Tuesday play. I'm not worried about it, and we're not going to stop playing silver right now because of what the central banks are doing. Just to get back to the 2012 levels, 47. And again, the problems are much worse now than they were when we had a little housing bubble in the U.S. And we can see the volume flowing into silver. The precious metal markets are very good at front-running QE, as that's their main, really their only big catalyst for upside potential is big pushes in QE. A lot of money flowing into emerging markets, ETF, hoping for a trade deal, and more importantly, trying to protect their equity market so they can continue to raise capital. Here's the German stock market. And again, note, U.S. equities are ready to break to new highs. Everyone else is stuck in nowhere land. FXI, these are the construction and banking companies in China. And again, they don't let you audit their books. I think they will just buy their own stocks and print money to protect these assets. So I'm less interested in shorting their stock market than I am shorting their currency now. Now that I've spent enough time to really dive into it. Here's your South Korean index, having some serious trouble. Russell 2000 even looks healthier than the rest of the stock markets around the world. This is the weaker part of the U.S. stock market, but it is on the verge of breaking to new highs as well. VGK, the European ETF, same place as China. LQD is your investment grade bond ETF. If this snaps, then the buybacks stop, but it's not. So the higher this goes, the lower the rates are for corporations to borrow, and this continues our stock back loop. HYG is your junk bond ETF. Has a very similar setup as the Russell 2000. You can see it is not at new highs or on the brink of it, but it is getting past that resistance level it's had going all the way back through 2016. And that is a wrap. Let's take a look at how you can call Dean right now to upgrade your account. We have a special deal going on till 1 Eastern today to save $2,000 a year on your subscription. Call Dean at 505-322-7515. We have a new trade alert coming out Monday, playing the SPY. Tuesday, we're doing our silver trade. Wednesday, again, is the SPY. Thursday, TLT. And then Friday, back to the SPY. It cannot get any easier than that, folks. You'll have an extremely diversified portfolio, and you'll have it with just 4 ETFs. So thanks again for your time. Is there any questions out there for me? Post them in the chat box. Otherwise, I hope everyone has a great weekend.